Okay, I cannot figure out why I'm crashing. My resources seem to be fine. What I can say is maybe me using Epic Pen might be causing some issues. So I'm not going to use my little pen, and I'm going to try and use more internal tools here. So pattern spotting, right? As we're looking, again, continuing on from the last part of the live stream before everything crashed to bits. Literally, my whole computer just dies off. Continuing from that last factor, we kind of have two potential drop points: 322 minus inflation, keeping that everything is fine in the market and all we're doing is deflating. And if we genuinely have a crash, as in companies are not able to pay all of their um, expenses, costs of profit, everything falls apart, people stop buying, consumerism goes to a halt, that might lead to another sense of stimulus, which will then increase inflation over time, futuristically. However, we're not going to focus on that. These are the two factors here that we can at least assume on a potential correction. This is deflation, and this is deflation plus crash. Technicals will say that we have the possibility of both. We have the ability to go down, recuperate inflation, kind of get that out of the way. Oh, wait a minute. My little dude. Uh, my little dude's just chilling there. Okay, I get it. It's being used by something else. Oh, that was annoying. Hold on, give me a moment, give me a moment, give me a moment. Dun, 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 dun. That's fine. Let's try again. Okay, there we go. All right, we're back in business. Okay, so we're back on that route. Oh, why did this change? Oh wait, that's a different place. This is hex desk. All right. All right. This was so messy to start. This is why I'm probably going to be editing these for a little bit of cleanliness. So we're seeing here deflation is a one possible drop point, a correction point, and then we go forth. So it would look something not as smooth as a single line downwards, but at the least a potential drop point and recovery. It might not be as big of a recovery. It could look something like that. And then we have the deflation plus crash, but we're not going to take a look at that. It could be anywhere in between the zone. It doesn't have to necessarily fall to one of those locations. However, just by inflation standards, we should be at around a 322 valuation for the overall stock market. That's one thing we can confirm. Going back to the inflation calculator, taking 1999 this time, pressing calculate, finding the worth of $1 in current modern day 2024, taking a calculator to that, grabbing the value of the current market at 608, let's call it 610. This is a top, 610 is our top, and divide by 1.89. So there's our 322 that we have a potential to enter, to jump out of, which in technical sense, we would hit nice points. We would hit a great support factor A lot of people are going to buy in this area, and I'm really looking forward to the consideration that this would be the bouncing point of our correction. Now, corrections happen, all for different kinds of reasons, and as long as the Fed doesn't print money, quantitative easing, fiscal easing, all financial keywords for somehow the Fed is giving more money to the market, not the people, in essence, then if that just stays quiet, we have this correction. And this would be simply a deflation correction, which is still 50% if we really consider that. It's about 46% downward movement. Now, my focus was not on the weekly. That's the overall perspective and correlation. Again, going back to our focus, this is where I really needed that epic pen, but hey, let's grab this. From here to here, not even there, hold on. Let's grab that back. Here, growth, here, turning point, here, here. So this highlighted space here is essentially working with the 2008 pump. As the market went up, as it does, we see this formation of essentially very robotic, algorithmic, it's a saw wave. It's a up, down, up, down, up, down. This isn't the RSI, and we're going to look at it from a different perspective because right now it's a very, very backwards, eagle eye, up in the sky looking down sort of perspective. We're not really taking a look at the price action just yet, and especially the relationship between the future contracts and today's SPY trading. So that's something that's going to be very, very visible in the daily once we get there. So this is our main focus. You can kind of potentially consider our 2008 2000.com bubble. Okay. One thing we can consider is that this pattern continues going. This is potentially because there's a lack of retail investors. You'll notice that this saw wave keeps moving in this format. This is a very organized method of trading. And as retail starts entering the market, Robinhood, Webull, um, Tasty Trades, Thinkorswim, all of these retail-based accesses to the market, you start to see that noise. And I like that noise. That noise gives me confidence that retail is playing very well inside of the market. But here in the 2000, 2005, 6, 7, we didn't really have those accesses to the market as a retail investor. We just literally started getting iPhones and cameras on our phones. We didn't have apps like Robinhood, Webull, Public, all of these brokers that give us the ability to buy Cash App, to buy stocks. We didn't have this. Okay, this was 2000. So it was an organized big financial broker firm, investment management. You would give someone your money and they would appropriately, like clockwork, follow the rules of the trade. Retail investors don't necessarily follow the rules of the trade. They react to price action. There's the buy the dip guys right over here. You see that the volume increases and this downward movement. So we have the buy the dippers coming in hot right there. We definitely got to buy the dippers here at these low points, right? So you can see where retail starts to play a big part. A volume going huge, spiking high for those values. So as retail enters the market, it becomes a bit more noisier. And generally, that is good because retail entering the market and playing in the market shouldn't give us any predictable factors. It's when they leave the market or something becomes so automated that that pattern pops up again now in our modern day 2022 to 2025. These are the locations. I've indicated those locations by the white lines, right? The vertical lines to kind of isolate those places. We can see it all over the charts. This location kind of worked out well for us. It didn't quite have the same robotic feel unless it was in the RSI. But on the daily, you'll notice the actual proportion of the future market by the current market don't quite match as smoothly. However, the RSI does give us a little bit of a hint, but I'm not really looking at the RSI for the next step. The next step, we're going to go into the daily. Right now, we're on the weekly. So we're about to zoom in. But I do want to highlight those locations. They're very visible on the RSI, which is the relative strength index. Now, let's go ahead and go to the day. What is it that really concerns me? Well, still within the range of what we observed on the RSI, except a little bit about that RSI. It seems to be extra volatile, going beyond the 70 and beyond the 30. If you don't know RSI in a general sense, anytime you approach any of these extremes, this is the sell signal, this is the sell signal, this is the sell signal, and this is the buy signal. Especially if you're looking at it on a longer time frame, they can be dependable. That's all those show. And normally anything above 70 is a buy, below 30 is a, above 70 is a sell, below 30 is a buy, because markets go up and down, right? Up and down, up and down, up and down, up and down. So you should be able to generally catch these movements and make the difference here and there on the longer term trade. But for those that are trading scalping, there's even a better tip. And that tip is right here. There's our saw wave. Not as much as the RSI gives, but still very visible in pattern. So this robotic notion comes back to play. We saw it happening on the RSI on the 2004-2008 range or domain. And now we're seeing it happen today. We're of course going to go back to 2008 again, but for now, we're looking at this and saying, hey, we're reaching back to a more robotic playing field. There's some algorithms, and today more than ever, modern day society, we have AI, we have algorithmic trading. You can even get an app that trades for you. You just put money in it, you pick your sector, and it'll trade for you. And of course, those automated systems are optimized to follow trends, whether fundamental or technical, which are probably technical 80% of their algorithm, 20% probably fundamental, based on the trigger points that a individual would say, hey, we're in a bear market, we're in a bull market, that's it. And then the technicals will guide the rest of the way. So what concerns me here is that we've reached a tipping point and we're kind of seeing, potentially I'm under exaggerating this. Keep in mind, these saw waves are about, let's see, about 2 month spans. So every 2 months we get a reset, start from the top, go bottom, 2 months, etc. So this is the next potential movement here. Why does that concern me? Because we don't technically see this very often. I did mention a little bit here, we did get to experience that saw wave in the price comparison or the price proportion between the main market or the current market and the futures market. Oh, come on, really? Get off the text. No text, please. But I don't have to draw every single piece. You can visually see it does get disrupted, and this is where it kind of gets a little chaotic. It starts algorithmically. starts to get a little out of control. If it's downward facing, if this is the case here, these red candles, in essence, started from above and dropped down. If it's dropping down, this is a dominance of the denominator, the current day. So there's a good day for the market here. If it's starting from the top down, still it started off with probable gap and then it went back down to an equilibrium. So the ES futures had a good day and then it went back down to an equilibrium with the current day. Now, it's not always the case, it's not that predictable, at least not in certain situations. But the one thing that can be noticed here, and I haven't crashed yet, hopefully I'm not going to crash because I'm not using my drawing device this time. But this is where my real focus lies in the historic patterns. What do you see here? An upward trend, right? We're going up forever to the moon. And then as the time goes, the more robotic the price action between the two, the futures divided by the current, tends to be. Until the breaking point where we break from that trajectory and noise re enters the market or human trading. And then the bottom pops in. We see tons of volume catching the bottom, tons of volume catching the upper high, another volume catching the upper high, and so on and so forth. So that's your typical pattern. Markets don't only go up, they do go down. Believe it or not, believe it or not. It's very easy to listen to the news, to listen to all the perma bulls out there, and imagine that markets always go up. Sure, if you bought at the top of 2007, you will eventually, 6 years later, recover that value. This is why investing is one thing. Investing is one way that you can avoid these ups and downs. You buy something at the price you like and you stay in, you don't move. You will look at some negative numbers for a little bit, but eventually you will see a return. It's just 6 years down the road, at least for this sample. However, being aware, you don't have to buy up here. You can buy in multiple locations, even on the downward movement. If you can catch the bottom, that chance is very, very unknown and probably a high risk. But as you drop, there's a couple of things to keep an eye on. It's the slope of movement. We had a slow drop here. We had some extreme fear here. And then we had some kind of readjustments to that and a slower slope. Again, that slower slope gives us a good kind of access point. If we see a big fear candle, big fear, what is this? Probably about a month, a huge sell off, we are looking for a slower slope, just like we had in the beginning. It starts slow, it goes crazy, and then it ends slow. And that's our key to jump in. All right. Those are a couple of linear ways to look at this because in the end, looking at it up and down and up and down and up and down is not useful to us on the short term. It's best to zoom out and observe the charts from a eagle's eye perspective. So I'm always looking for a big dump and then slower downward, even if it's in the 5 minutes. I will play options on the 5 minute, waiting for a big dump, and then just making sure the next downward motion has less of a slope, less of a negative slope, if you know your linear algebra. And then I'll go ahead and probably buy some calls somewhere around here. If not, a little bit higher, probably somewhere around these points. Anywhere in between here. As soon as I catch that linear movement down and it's not going too far down, then I'm like, all right, looks like we're stabilizing, get in, right? Same thing here. We have a downward, and then eventually we have a slower. We have 1, 2, 3 taps. This is a Head and shoulder reversal. Technicals come into play very, very well. But my concern still flows with what we're seeing or what we have seen in 2004 to 2008. Here's the future and here's the present being divided again. Here's that same saw wave pattern. You see it? Should be pretty straightforward. We don't see it before. We definitely don't see it in the case of after the crash happens from 2000. We kind of see it before the crash. And then we see calm. Calm human noise, no real particular form. That's really the calm case scenario. There's no form in this range. It's less robotic and more unpredictable human noise. So my concern is the fact that there's multiple times in history that we have seen this saw wave pattern form in the future to current day division of the SPY or of the futures contracts and the SPY. We see this here, crash after. We see this here, crash after. And we're essentially seeing a similar factor here. And what happens? Crash after. Now, there's no deduction on length. We don't know if there's going to be 4 more months of this, 6 more months of this, but I am starting to see, if not very quickly, here's a very stable case. These are stable sort of saw waves. And then we have this pop here. It breaks out. Then we have this pop here. And then we have a little bit extra here. And I'm just waiting to see this saw wave start to break apart. Once the saw wave breaks apart, I will enter a lot of hedging on the market. So outside of inflation, as in part one, and it looks like we'll be continuing, there is historic patterns in this part too. Let's take a look at some other factors. We are looking at technicals specifically here. We looked at fundamentals in part one as inflation and the effects on it. We know deflation potentially is going to lead us to about a 300, 340 range area. If we have an actual crash, however, with a deflationary environment, we can see a support that hasn't been tested from the 2000 and 2008 era. So there is a chance we can see a support bounce here with huge volume buy-ins. However, I'm probably 80% on this particular location. This 300 value space is my 80% chance, and the complete deflation plus crash is just a 20% chance. So I'm going to play only the particular safety. Now, how am I giving 80% chance for this? Why am I not showing upwards movement continuously? Well, there is a case again for that German inflation situation. This would be very, very, very bad. Yeah, of course, if I notice some oddities happening, I'm probably going to jump in on a lot of equities, a lot of commodities, and I'm going to ride that because the only people that will survive this is people with actual investment. Holding cash will be horrible. This will be the collapse of the dollar if this goes to play. Now, there's other case scenarios. There's the Warren Buffett indicator, the GDP to the market correlation. So GDP is basically how much our overall economy makes, which is this nice line down here. A healthy, decent GDP is 120% of our upper or above. So 20%. If you think of this line as the 100%, the historical trend line, of our GDP. 20% above it is good. So this was good in 2008, dropped below it, issues financially. Now we're above it again. We're way above it now, and we're at a 218% valuation in comparison to the GDP. So even Warren Buffett has his particular concerns. So we can drop from 218% currently down to about 120 equilibrium. That's about 100% down, or in an essence, cut it in half. That's about the $300 value that I was talking about earlier. 320, give it a little buffer. So this is another set. You should never go into a market with only one indication. This is why personally I go through fundamentals, sentimentals, because this is going to be the trigger. Sentiment on the market is the trigger for something to happen. Fundamentals is the buildup of how much it can happen. And then technicals is the timing of potentially when it could happen. You have to use multiple perspectives. Okay. This is Warren Buffett. This is his particular evaluation, and this is just 2021. This is before or maybe after. Yeah, this is right before the crash of COVID, right? No, no, no. COVID was over here, no? 2021. Let's check that real quick. 2021. Yeah, COVID was over here, 2020. So we had a recovery, we had a drop. So over here we were 100. Okay, hold on. We are 220% up here over GDP. And let's say GDP continues to grow slowly, we might be at about 230, 40%. So regardless, we're evaluating based on the difference of GDP production in the country versus the market. They say the market does not reflect the economy. The economy is GDP. The economy is this observation from Buffett. There's the economy. The market is up here. So there's another second case scenario. Inflation tells us we can drop. Warren Buffett tells us that we're due for a drop. Each time, if you notice from any of these, we always gravitationally orbit around the historical trend line. Okay. Now we're up here and we probably will have a little bit of a drop. So these are two fundamental pieces to the whole puzzle. And one technical, we observe that little technical observation because, again, it is projecting similar issues in the market based on what I saw in 2008, 2004 range, and even a little bit on the dot-com. So this is forming, just as it did in the past crashes. Fundamentally, now this is technical. So let me actually make some notes here. So here's my bearish sentiment. Bearish. Okay, how about bearish signals? We have fundamental. GDP to market ratio. The inflation valuation, 2000 value equals 320 current dollars. GDP to market ratio is of course about a 220% above historic trend line. We have a technical in here. Futures divided by, this is one technical, I'll show you some more technicals. Futures divided by current SP 500 or contracts versus trading or divided by trading. See? Okay. So I like to grab three of each. Three of each. So right now we're at two fundamentals and one technical. That could constitute a pretty decent three, but I like to go further and find evaluations forward. Now, I will also enter in a bullish. Quantitative easing. Fiscal easing, printing, lending money. If this increases, because currently we have quite uh, strict money lending issues in our system. We have very high interest rates. If you've seen a credit card, you're looking at 30% interest rate. That's ridiculous. That's absolutely horrid. So quantitative easing would mean we're either printing money, stimulating the economy, or potentially lowering the interest rates further to promote more lending, which is another way that our money system creates more money out of thin air or prints money until that money is basically returned from the lending. Like you lend $1,000 or you borrow $1,000, you got to pay 1,100, let's say. That's $1,000 that poof came out of nowhere. You have it now as a number on a bank account. It's not backed up by any particular thing. We stopped the gold standard a long time ago. So that $1,000 is given to you as a form of printing, as a technical form of printing. It's not actual money being printed here. And then you pay the 1,000 back, that money goes away. And that's how it works. That's how the current lending system works. This is a debt-based economy now. It's not backed by anything other than how much we can lend to others. And then the kind of inflation rate is the principal. So if you borrowed 1,000 and you paid 1,100, that $100 was technically the principal. So now there's $100 that you're paying the bank that didn't exist before. For the 1,000 that get canceled out once you pay off that 1,000. This is the way money works now. You can technically still print with bonds, print some future bonds, you 5-year, 10-year, 20, 30-year, just the US selling its debt basically, getting money by exchanging a piece of paper with a promise that whoever buys your debt gives you the money for this piece of paper is going to get a return later down the road, 5, 10, 20 years down the road. So technically you're getting a contract, piece of paper. You're paying for that piece of paper $950 with the promise that in 5 years, that piece of paper is going to be worth $1,000. So you make 50 when you go back and re-exchange backwards. This is how money is printed, guys. So from my 950, now there's an extra 50, you get to take that because you were giving money to the government or the Fed to use as a debt to fund its everything, whatever it is, whatever necessary. This is how when we have a deficit, meaning that our country makes maybe $2 trillion a year, but it spent $8 trillion. That 6 trillion in between is one of these debt vehicles. So this would be my bullish signal. This is bullish because this will give the ability for continuous growth. However, more printing equals more inflation. And that brings us back to Germany. This is my concern. How long can we do this for? Before so much printing is necessary and so much debt is accumulated. And have you seen the current debt? If you haven't, US debt clock. That's where you take a look. So how much is our debt right now? Mm, it's gonna hurt to see. I remember when it was, oh, wow. Okay, well, that's a little bit of a messy Okay, there we go. So we're at 36 trillion and growing fast. I remember when it was just 10 and 15. So, yeah, this is going up heavy. We're minus 36 trillion, not minus 6, as I mentioned in the example. So all of this money can essentially be lent for use, but then we double the amount of money in the market. We're printing extra money. So we keep doing that over and over, we're going to end up with a German type hyperinflation. That's my concern. However, that would be bullish. What is a bull? Bull doesn't mean market's going to do great. Bull means, oh no, you need something outside of a dollar in your bank account. You need gold. You need equities. You need a house. You need something that grows or at least keeps its value. That's what bullish means. And in the case for to the moon bullish, well, then you probably want equities. You want to find the specifically undervalued equities and go into those at the right time. Okay. So there's that. We've got our little notes here. GDP to market ratio, far above historic stretching, historic trend line, inflation valuation 2000 value for the SPY. So while technically, if we take our money back to the year 2000 value, our current market would actually be evaluated at 320, but it's actually evaluated at about 610. Consider that factor. We have a way down from inflation or deflation if we decide to unwind some of that and be responsible with our debt. But even then, we still have all kinds of different crashes involved. The next one that I like to observe is the USO2, that's the 2-year Treasury, divided by the US 10 Treasury. I love the vision. The vision simplifies a lot of things. Notice we're in the monthly timeline. There's a particular value we want to keep track of, and that's the 1%. 1% in this case scenario in the division, as normal, tells us that the numerator and the denominator are the same. And in the current definition, the numerator is our short-term bonds and the denominators are long-term bonds. So at the one value, we tend to have equilibrium, which is technically odd, considering that if I asked you right now to lend me money for 2 years, and then you were, how much would you like me to pay you back? You'd probably say, I don't know, 10%. For 2 years, $1,000, I can deal with 100 extra. But then if I ask you on top, hey, if I lend this money for 10 years, you're not going to do that twice, right? You're not going to give me just a 10% interest on that because now it's 5 times the time. This is $1,000 that you won't be able to use for 10 years versus 2 years. So the general accepted fact of bonds, of any sort of lending, is the longer the money is out of your pocket and being lent to someone else, the more money you want back. That's just logic, common sense. If I borrow $100 or $1,000 for a week, you might not even care. Maybe you'll charge me 5, 10, $15. Super, super tiny values, right? That's how lending works. Short period of time, smaller interest. Long periods of time, higher interest. That's the normality of things. So short period of time, 2 years, lower interest. The numerator should be smaller than the denominator because the denominator is 10 years. And if we have 1 in the denominator, or let's say we have 2 in the denominator and 1 in the numerator, what's the value we have there? It's a decimal. It's 0 0.5. It's a half. We can do this all the way to like 99 in the numerator and 100 in the denominator. This is still a case where the bottom, the denominator, is higher. So it still bears a type of not as nice. I mean, for that amount of time, I'll probably lend it to you for $2 if you're gonna give me $99 instead of, you know, 10 years for $100. That's a $1 difference. Do you get that? There is a certain breaking point between how much and when and how long you want to lend money and for what value you want returned. That's my point. So then there are two sides of this 1%. Remember, 1%, this line I've drawn here is where it's literally 1 divided by 1. Now, there is a particular pattern. I'll let you see this before I explain what it means. And I'll also start marking our previous crashes. No, this one goes back to 1990s. Nice. Do you see a pattern here? The lines signify the timeline in which potentially we have entered a crash or will enter a crash within the next few months. What happens? We are above this 1 divided by 1 line. We are above the 1 divided by 1 line. We are above the divided by 1 line. Even in 2020, we know it was a COVID thing and it was a bit of a different sort of situation, but we still see that. We still see a little bit of a peak above before boom. Okay. And that was a very quick crash. So in respect to how long we stay above that line can kind of charge us up for a different level crash. Now let's put SPY on the chart. Let me do move to its own pane above. Do you see the indication here? If not a couple of months, this is the general rule. This is called the inversion, the interest rate inversions, and the reinversion. So the explanation here is when our comparison, our division of short-term bonds divided by long-term bonds, when we are above this line, we kind of determine what happens in the lower half of this, underneath this 1 divided by 1 location. We've determined that it's better, it's common sense to lend long periods of time for higher interest rates. That's what happens here. This value is an interest rate. So having our actual underneath swoop here, all of this is where the 10-year had a higher interest. We gained more money for logically lending out our money for longer periods of time. This shows also a comfort, a 10-year comfort. When we're comfortable about the next 10 years, we're easily able to lend money out because we know we're going to get it back. When we reach this upper segment here, this upper segment, and this little teeny tiny one, this little teeny tiny one, this little teeny tiny one, and this monster, this is not normal. What we basically consider above the 1 is that the value in the numerator is bigger than the denominator, aka the interest rate on the short term 2-year You're getting more money to lend out for shorter periods of time. You're getting less money to lend your money out for longer periods of time. That's weird. That makes no sense. We kind of determined that in the beginning. The common sense is when you want to give someone money for longer periods of time, you expect more to be back because it's money you're never going to use until the end of that long period. So for 2 years, you're willing to maybe part with $1,000 if you get 100 back. For 10 years, you might charge like 500, right? 5 times since 2 to 10 is like a 5 time multiplier. So you can logically say, hey, if this is just basic math at this point, this is not just interest rates being calculated through complex mechanisms and tools. This is just logic. $100 for 2 years, that's how much you're willing to take and give 1,000 until you get it back. And you're gonna get 1,100. And let's say for an extra 8 years, or 5 times 2, 5 times the original 100, you might be willing to lend it for $500, 5 times 100. So you're going to get back 1,500 because you're not going to be able to use that money. Good. That's where we want to kind of hover on because now we're at a point where it's cheaper or you're getting more money for lending basically in the short term. Not only 2 years, but 1 year. And we've been doing this since 2022. 2022 is the case for where we began this inversion of the yield curve. It became more return to lend for 2 years instead of 10. Now, why would you want to promote that? Maybe there's a case for a bit of uncertainty of what will happen in the next 10 years. You may not want to lend out for longer. You may want to make rates look nice in the 2 year. Because why? Because you don't want to lock up any money in the 10 year. The person that is borrowing the money might not be able to pay you back. So most people will focus on those interest rate differences and lend on the short end of that curve, on the 2 year value, because you're going to get it sooner and then you can keep watching the market and seeing what happens. 10 years, you locked in for a long time. A lot can happen in 10 years, right? So that's the next signal here. Not only is the general logic, this is a very common tool used in determining the health of the market. Now, I've noticed a couple of things. I have kind of given it a decent rate, but I'm going to adjust some numbers here because it's not just us crossing down from short term better to lend to long term better to lend. But there's also a certain type of large candle that plays a part in the beginning of the crash. Here, it's the beginning of our downward movement. That's one. We can one say here, we can say also technically here, but it's a giveaway. Big candle, downward turn back, starting at the big candle. And going all the way to here. Okay, let's do our 2020, just not to get that out of the way. It's a pretty decent big candle in retrospect of the previous. That's kind of two big candles here separated. So it was an upward, it was a kind of flat top at the first red candle. And then the next red candle dropped it further. There's a certain percentage that I've identified that if we go away from that particular equilibrium, about 10% off chart, is it 10? No, I guess it's a 20 value. So 20% off that value there. This one's way more. This one's, oh, this one's still about 20. Okay, 20. This one's about 10. Okay, so it depends, but 2000 was an interesting year, to say that the least. So here's another signal that I'm seeing based on everything we just discussed. We're almost at a 10% divergence down from the equilibrium. It seems potentially clear we're going to see something similar to maybe 2008. Some warning down ones and then some big down ones that we're going to keep an eye on. But if you notice those on the inversion, you will have a pretty decent forward sight. So even here, even if I take this on a little bit to the right, so here's that big red candle on the USO2Y and the US10Y right here. And you're not that far off. You have a couple of what months? What are we at on the month? We have 1, 2, 3, 4, 5, 6, 7 months until, right? Here was much more instant. COVID. It really happened overnight because of everyone basically being locked up. This is when the fundamentals came in and took over. When you're locked up, you can't go to work. When you can't go to work, no one can sell anything. When you can't sell anything, your whole economy stops working. This was a month. So potentially, I'm not giving any timelines, but even here might be the sign that 6 months from now, because this was the first underlying candle right here, and things are happening so quickly nowadays because everyone's got a mobile app that can instantly log in and sell their stock under pressure. We have 1, 2, 3, 4 months, and potentially we have another 2 months potential to, I'd even give it 2 to 8 months range. Okay, this is a fundamental. Let's fill in the gaps. I mean, I don't have much for bullish, but this is basically the don't fight the Fed. Because in the end, this is the one thing that they can do to stimulate the economy. And basically, everything that's being set up here can be what they say, how they say is kicked down the road. You can just kick the can down the road for a next attempt. So while there's plenty of signals, this is the one big piece that if I see banks reducing the amount that they have to keep from your money in their banks, freeing up cash. If you don't know, when you put $100 in your bank, you only technically have $10. The banks take that 90 and then invest it. That's the 10% kind of backing. This is why if a lot of people go to a bank run, yikes, right? So there's a couple of things that can happen that no matter how intricate you are with fundamentals and technicals, yikes. Okay. And one of those is the bullish signal that don't fight the Fed. They're going to print more money. They're going to continue this upward movement, and inflation is going to bite us in the ass later. And then what's the other like bearish guaranteed? Bank run. People are scared. They don't have money. They need money. They take all their money out, maybe invest it in the gold because they're becoming more aware of the situation of inflation. And that's going to basically do a lot of damage. That's why there's restrictions on how much money you can take out. Like 500 a day for some people, 1,000 for others. It depends. So the other technical, so I got 3 fundamentals, check mark, check mark, check mark. That's all I need. That's the bearish signal there. The technical, then we go to the next case, the XY. This is the dollar strength. It's still technically a fundamental. However, I'm more focused on the technical patterns of the dollar strength. There's one thing that I can say about it, and it's that if other countries, because technically, if we look at the dollar value here, DXY is another fraction that we've just watched. We've seen two fractions already, the futures divided by the current, the 2-year divided by the 10-year. Now, this is the USD divided by other currencies. The euro, I believe it's a times or plus or some format, but you're combining basically every single currency, the yen, and any big player in the global market. This is what DXY technically represents. So, if we take a better look at this, what happens to the US dollar when everything gets weak? Right now, we see Germany falling apart. We see a lot of pressure in the EU economy, inflation in the EU economy on top of it. If all the other values of the monetary FX systems lose to inflation, their actual relationship to the dollar goes down. Meaning that if let's say you're still trading bread. This is the easiest way to think about this. Let's say you are still trading bread. You're literally on a farm, right? And that's your currency. Instead of bread for others, it might be the euro or it might be the yen, regardless, right? If inflation happens and that particular bread costs more, it's not that the bread changed in any way. It's that what it used to be to get one loaf of bread for, let's say, $1 now becomes a little bit more difficult. Now you have to pay $2. That's inflation. The relationship starts to change. That's inflation. That means your dollar, your money, whatever you're using to exchange, loses power. So you have to use more of them to get the same bread. So instead of $1 to get that bread, now your dollar is less worthy, and now you got to pay $2. Cool? All right. Awesome. If the power of these other currencies like euro, yen, and anyone else within the DXY loses its value, then the US dollar basically goes up. It doesn't even have to change. The US dollar can technically still be going down. The US dollar can start at 10, and then all of them added in the bottom can be 9. Then you have something of a decimal here. So your DXY or the dollar worth is about 1.11. So if you want to get any other values, you take a dollar and you're going to get 1.11 of whatever the other exchange is. Now, if the US dollar stays at 10 and everyone else has a loss in value, all of a sudden now the DXY is greater. I mean, you can even consider that maybe the US dollar goes down and inflation attacks and everything else stays at the 5, you're still looking at a higher value. This one's 1.6. So all it takes is for the dollar to get weaker, slower than the rest of the world, and this guy goes up. Now, I don't know if you've heard about China, Japan having issues, Germany having issues, Italy, France. There is a lot going on right now in the world economy. So all it takes is for the US dollar to be relatively, and I'm talking relatively in form of the others around it, to be relatively stronger, even if it is going down from 10 to 8, right? Even if it's going a little bit down, if it goes down slower than the rest, then DXY goes up. Okay. So, next step. How do I? No, I gotta do Control Z. This is why I don't like this. All right, so back to the idea of bread. Now, instead of bread, you're trading stocks, right? If the dollar goes up, it's a strength. We talked about the opposite case scenario. We were talking of if your value, your currency loses value. Oh, sorry, wrong place to look at. If your currency loses value, because this is still the SPY, so if your currency loses value, let's say from, I don't know, 2 buying power to 1, and it was basically 300 for a stock to be bought. Well, now you're going to need double because if you bought at the 2 valuation and now it's worth 1, well, now your stock is going to be worth 600 because you need less or you need more dollars in the inflationary case scenario. $1 is worth less. So if your bread costs $1 and all of a sudden the dollar is weaker, now I got to use $2 to buy that same bread. So if our bread is actually a stock at 300 and it goes down in value, well, now we're going to basically nothing changes. The power of the dollar will still be somewhat kept, but it will look like it's more money. That's how that works. So if I can simplify all that, because it is a bit of a mind twist here, if you just kind of really focus on the bread example, it'll make sense on why inflation causes your prices to go up, even though you're making less or making the same amount. It feels like everything is getting more expensive, but it's just inflation. It's still losing power. So here's what we can just kind of summarize just from that concept. If dollar goes down, you need more to buy that thing you want to buy. So you need more dollars to buy the SPY, therefore price goes up. This is another situation that we can see basically a good place to be is not the dollar, it's anything else. It's equities, it's a house, it's gold. This is what happens, right? You can maintain that power of the dollar by investing in other things that are not the dollar, at least in inflation. Now, we don't think too much about the other case scenario, which is less likely, and the government hates this part because there's a little collection with debt. The debt is like if you borrowed $1,000 10 years ago, and now that $1,000 is worth $2,000 today, well, you borrowed 1,000, you are holding 2,000 because of inflation. You can pay back 1,000 and then keep 1,000. That's weird, right? Well, that's kind of how the government pays its debt. It loves to do that. It loves to borrow in the past for less, let inflation run its course, and then pay off the past with inflation and keep a little bit on the side. Now, the other case is if the dollar continues, because right now the form is that the dollar is strong in relation again to the rest of the currencies. The technicals here will show us some details. So if dollar goes down, market goes up. That's all we have to remember from that whole conversation. However, if dollar goes up, market goes down. Can we correlate this? Yes, we can. Absolutely, we can. Do you notice something here? What happens at the bottom of the market? Maybe a little bit laggy. Dollar goes down, market goes up. What happens when we crash? Market goes down. Let me kind of modify that. Market goes down right here. Market goes down, dollar goes up. Now there's an odd way to look at this because you would say, hey, if the market's going up here, shouldn't the dollar be going down? Give or take. Long term, it's a little bit messy to look at. However, on the shorter term, you can see that here, it's not a one-to-one. That's the thing. It's not a one-to-one because there's still money being margined on loan, lend, stimulus, so many factors that are getting involved. So it's easier to see in the long term, not so much the short term. So here, market goes up, dollar goes down. Market goes up again, dollar goes down again. Then there's this weird case where both the market and the dollar go slightly up sideways. Dollar goes up heavy. Market gets flat. That's an interesting case. Sometimes not the correlation, but it is a stress on the market. If your dollar goes up, you would expect it to go down, but potentially that would have caused fear and a sell-off. So there's probably internal factors that are involved when market or when the dollar goes up to maintain the market, just to not put fear into the market, because it's easier to control when you are on an upward trend than when you're free falling down. Here's again. A key point. These are all technicals. Market goes up, dollar goes down. Maybe not proportionally, but it's still the case. Interesting here, market goes down, dollar goes up, dollar goes down, but stops. It's very stagnant now. The dollar is very persistent here. However, as persistent as it is, the market continues to go up. So even though they're trying to emulate a downward dollar, market is going up far beyond the limitations. This is where it gets interesting. The pattern is lost within this span between the last 3 years, which is potentially the trading mechanisms we saw here, the algorithms coming in to optimize our market. Could that work? Maybe. We could save ourselves another drop down. We could print out money to go to up again and then only postpone for a later drop down, potentially. But it has been a lot more difficult for them to control the dollar. You can see the rest of the world might be falling apart, and the US Fed has no ability to control that. And these are some big green candles popping up from our EMA 100-day moving average, exponential moving average, right? Yeah, exponential moving average. And that popped up heavy. There's some force trying to push it down, and it cannot push it down anymore. This is on the monthly. So either we haven't seen that drop from these four green candles in the last 4 months. We kind of got to this weird tipping point here. And if this keeps going up, there's going to be more pressure for that market to start going down. And as far as we know, Trump wants to have a stronger dollar. He wants this to go higher. He wants to put Tariffs, a lot of tariffs, which will increase the strength of the US dollar. But how it'll make things more expensive, potentially. Depends on how they do it. As a consumer market, we have a lot of demand for products, and even if the tariffs exist, people are still going to want to sell to the United States. We have that upper hand. We have a lot of consumers. So even if the tariffs go up, it's one of two things. Either we as consumers will see that price go up, or as the recent trends have been happening, there's this weird trend that I started seeing, no buy trend, making 2025 the year of no buy. Well, producers need to sell. If this continues as the beginning of January 1st, look at that. It's getting some vibes, a lot of eyes on it, a lot of reposts. Here's another person going on a no buy for 2025 unless necessary. So people are not spending on extras. They're going straight for necessities. So what's going to happen there? There's going to be a tug and pull between tariffs and producers wanting to sell to these people that are in the no buy mode. How do you convince people to buy things? Cheaper prices. So instead of the consumer paying more, the company is going to have to deal with making less just to move product. Cool. To add to the notes, DXY, strength, which is again technically a fundamental, but I'm really going to go for that technical here. But then again, I can go in fundamental. I like fundamentals better, so we're going to say tariffs. Tariffs, no, I wouldn't even call tariffs because tariffs can balance themselves out. Tariffs are not going to be necessarily the issue in the market. Tariffs can actually do good for the local economy by focusing work and production back into our own economy, coming from the inside, instead of always having to import cheaper stuff. So tariffs are actually on the fence. It really depends on the person that is applying those tariffs. All right. And we'll see how this no buy 2025 is going. Let me see if I put this quotes around it. No, it's not too crazy. Oh, wait, no buy challenge. Oh, there we go. This is not the US. So this is a global phenomena. Defense policy reforms for 2025. Um, Hearing everyone talk about doing no buy 2025 when I'm definitely planning on doing more buy. I guess, but look at that. Not so much, huh? Not so much attention there, not compared to the others so far. No buy challenge, viral, okay, pretty decent. No buy 2025 challenge, TikTok, Instagram. I mean, we've got a lot of countries. Again, we are looking at a kind of differentiating factor between the dollar strength. Other countries are potentially experiencing more pressure from inflation, and that will keep driving this up. And as the others don't buy, that's going to cause strain on other economies even more, which will affect your currency, which will technically, by proxy, make the dollar stronger. Think about that. So there's a lot of dominoes that can essentially fall over in a lot of different situations, but we are seeing something cooking. And I want to go back to this, just kind of ending it on this note. This is not a normal, I mean, this is normal for the case of automation. I would say this is very normal because in this case, we had zero interest rates. I mean, like, okay, not zero, but 0 point something. This was 0.02 or whatever interest. The 22 COVID. No, okay, hold on. I'm looking at the wrong area. Even further behind. Right here. The growth from the 2008 all the way. This one. So when I see this, I see less forces, if you think physics, less forces against people borrowing money and spending money. And this natural upward movement shows this kind of random human noise. It's only when we start to form a robotic saw wave that starts to concern me. This one, not so much. This one, I wouldn't call this a very big indicator, but it's still there when you zoom in on the daily. On the weekly, it's not so prominent, but here is where it really is prominent. And this is our current day now, and all the potential pieces we just saw. The only real bullish case scenario is if the Fed prints more money. Prints money figuratively, right? We're not actually physically printing money anymore. It's giving motive to lend money, the lending process we were talking about. Money is created today by lending. So a bank gives you $1,000. They don't have gold behind that thousand. It's a digital number that went up on their bank account. And you give them back 1,000 plus 100 for interest. The money that they lent you that came out of nowhere is positive 1,000. The money you're bringing back that you're paying back with actual physical work is minus 1,000, and they cancel to zero. However, the 100 you're paying for the right to borrow that money over a period of time stays in circulation, and we call that inflation. And normally we like a 2%. 2% inflation sounds nice, but it's been a lot more seasick inducing waves of inflation lately. So we're going to see more. There's my full run through, and there's a lot more I can go into, but this is really, really, really the focus point. I can go through a lot of details that I've discovered myself, but GDP market ratio, Warren Buffett, inflation valuation to 2000 to year 2000 value, the technical valuation without inflation is 320. That's a potential dropping point. And the technical is also support. Let's do that. Support at 300 and let's say 30 to 350. So that still plays into part here, based on here. The green one, the deflation one. It's about a 322. So that's why I'm more confident in a correction down. What would it be? It would be about 50% correction, man. We do that. We do that. People that don't believe there's going to be a correction forgot about 2008, forgot about 2000. That's a 45%. That's a 50%. Markets don't just go up, folks. You have to be prepared for anything. So don't be a perma bear. Don't be a perma bull. Both of you are idiots. Get your data, get 3 forms of technicals, 3 forms of fundamentals, open your mind to information, learn, keep learning, keep updated, and good luck. Because I feel like there's going to be a bit of a storm coming up soon, especially with California fires, insurance. Oh, New York stores leaving because of shoplifting, and Amazon losing money because bandits and gangsters and crooks are literally stealing or stopping Amazon trucks and FedEx trucks and stealing the product, and then they have to reimburse the people money. Oh, I haven't even talked about current day events, guys. This is a eagle eye perspective. This is the last 20 years. Open your eyes to the current day. It's pretty row. So, I'm your friendly garbage panda. I love the name. I'll check you guys later. Have a good time. And be safe. That's the important part. Be safe. Don't be a perma bear. Don't be a perma bull. Both of those are basically dual sided mentalities, just like being perma Democrat, perma Republican. Those are prepackaged mainstream ideologies. Snap out of it and talk to you later. Bye bye.